Welcome to Non-Consensus Investing. I'm Ram Alawalia, your host and CIO at Lumida Wealth, where we specialize in the craft of alternative investments. At Lumida, we help guide clients through the intricacies of managing wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their clients so that you too can invest beyond the ordinary. Hello, everyone. It's Monday near 4 p.m., June 16th. Happy belated Father's Day. I really enjoyed it. I'll share a highlight with you. I want to walk through a couple takeaways touching on the Iran-Israel conflict and some other thoughts from the Lumida Ledger newsletter. I'll give you a quick punchline. Things are pretty bullish. I think you could get a melt up this week. It's very hard to find a sector that isn't constructive, between technology to consumer discretionary to financials, which are all working today, and healthcare, which will probably work in the back half of this week. Earnings estimates are going up. Inflation is coming down despite tariffs. The geopolitical risk is abating. Hard not to be very constructive here. I think people are getting worried about a Ford P that's elevated. They're forgetting that analysts ratcheted down earnings estimates in April, and the trailing P is actually 3 points lower than the peak trailing PE from a few months ago. So still room to go, and earnings growth is still here. I think you're going to get more breadth expansion. You'll get more rotations too, but I think I shared last week a pod where I went sector by sector and just talking about positioning. We come back to that. I did want to spend 30 or 35 minutes here talking about a few topics, but this is a fun topic. This is a book I started reading around Father's Day. It's called Letters from J.D. Rockefeller to His Son. I think they should make this required reading in American high schools, by the way, okay? Let me share with you. I'm going to read this out for you. It's a minute or two from chapter 3, comparing heaven and hell. Again, this is a letter that John wrote to his son, John. It starts off by saying, the greatest reward for our hard work is not what we get, but what we will become. Not what we will get, but what we will become. I thought that was a really ennobling idea there. Let me read the opening part of this letter. This is 1897, November. It says, Dear John, this is an allegory that is very meaningful and provided me with a lot of insight. It goes on to say or share this fable. He says, in ancient Europe, a man found himself in a wonderful place where he could enjoy everything in his afterlife. As soon as he stepped into the piece of music, someone who looked like a waiter came over and asked him, Sir, do you have any needs? Here you can have everything you want, delicious food, all possible forms of entertainment, and all kinds of pastimes. Amongst them are many beautiful young women where you can enjoy as you please. This is before the Me Too movement. After listening to the waiter, the man was a little surprised but very happy, as he happily thought to himself, this is not my dream in the world. Throughout the day, he had been tasting all the delicious food while enjoying the taste of beauty. However, one day he was bored. So he said to the waiter, I am bored from all of this. I need to do something. Can you find me a job to do? He did not expect that the answer he received was the waiter shaking his head. Sorry, my sir, this is the only thing we can do for you here. There is no work for you here. The man was very frustrated and waved his hand angrily as he said, this is really bad. Then I will just go straight to hell. Makes you think. But here's the punchline. Sir, said the waiter gently, where do you think you're at? So in this conception, hell is a place where you can't do work and you get all these heavenly delights and treats. Really interesting, right? So he goes on to say in this chapter, when I first entered the business world, I often heard that a person who wants to climb to the peak needs to make a lot of sacrifice. However, as the years passed, I began to understand that many people who are climbing to the peak were not, quote, paying the price, end quote. They work hard because they really like work. People who climb up in any industry are fully committed to what they are doing and are dedicated. Sincerely love the work you do, you will naturally succeed. It's like Kobe Bryant, work is play, play is work. It's the whole Nike ethos. And he goes on to say, and I'll wrap up here, income is just a byproduct of your work, doing what you should do, accomplishing what you should do. The ideal salary will come. And more importantly, the highest reward for our hard work is not what we get, but what we will become.
That's a really powerful idea of what we will become. There's this old myth in Greek mythology about Pygmalion where the artist is sculpting a piece and it's his ideal conception of the feminine. It comes to life and that creation is Pygmalion. What he is saying is you're sculpting yourself through your work. It's a really, I think, a very powerful idea. So I want to share that with you. That's John D. Rockefeller, letters to his son. This guy, he started his job as a bookkeeper doing accounting. And he had very high ambitions. And he talks about how essentially he created the modern integrated refinery through like a roll-up play. Like he was the Brad Jacobs of 1897 doing roll-ups of these refiners. It's intriguing. Just one chapter a day. They're bite-sized. I'm enjoying that. But one other thought on this, and we'll get back to kind of markets. I was at the playground Friday night, took my boys there, and Sunday night as well. Actually, they have like a baseball field there. Friday night and Sunday night, they're just this athletics all over the place. Multiple fields activated. It occurred to me that Americans' leisure time is actually a form of work. And that work is called athletics or sports. It's another kind of recreation. It's back to this work as play concept. Americans are competitive. And that is one of the reasons why I think the American economy just has another level of dynamism than others. What do you learn from sports? You learn competition. You learn fair play. You learn leadership. You learn the captain picks his team. The captain's accountable. You learn winning. You learn losing. You learn about the role of an umpire, of referees and third parties. You learn about team morale and cheering. You learn about practice. You learn about discipline. And the United States is one of the few countries where there's sports all year round. One of the highest rates of an American playing at least one sport per year. You've got not just soccer, the whole world has soccer. We got baseball, basketball, football, tennis, pickleball, racquetball, CrossFit, you name it. Only one other country has a higher incidence rate of athletic participation, which is Australia. And the funny thing about Australia, I think Australia is a great economy. I was the best man at a wedding of a friend who grew up in Sydney. I've gone along with Australians quite well and quite easily. And I think it's the same thing. They're very commercial, industrious people. It's the competitive spirit. So I want to share that with you. Americans never stop. They never stop. That drives American management. This is why what Warren Buffett talks about investing in the United States, among other reasons. But isn't that one of the reasons? And that's the competitive spirit that you pick up when you're reading J.D. Rockefeller. And his mindset is in here. So hopefully in the next coming podcast, if you found this of value, I can pick out different chapters and excerpts. I know everyone's short on time, but you want that kind of nugget of perspective that I appreciate. I can share more of that. So anyway, that was one highlight. I want to talk about this conflict between Iran and Israel. I wrote about this in the Lumida Ledger this past weekend. I'll put it up on the screen here. I'll share some highlights. This is one of the images we shared. You can probably guess who's Israel and who's Iran in this one. This is like a completely uneven matchup. What's interesting about this is that over the last month, we've had small geopolitical skirmishes and conflicts, right? You had Pakistan and India, and you had the U.S. Navy and the Houthis, and an F-18 fell over an aircraft carrier, and then some other one went defunct. I started wondering about like the strength of American force projection, but Israel really put to bay those questions. They're using F-35 jets, and they have intelligence, significant intelligence, in large part because there are hundreds, we don't know how many exactly, but many people, part of the Iranian regime, that are providing intelligence, pinpoint precise intelligence, because they don't have confidence in the regime. This is a population that in 2009 and 2011, they were college kids protesting. And now they're in the mid-30s and they're in government, and they've got an autocracy, a theocratic autocracy. There's no representation. And now it is really amazing where I saw a message yesterday where Iran said, we'll pursue peace when Israel stops bombing us. What the hell message is that? That's putting the condition in the opponent's hand. And it's really, it does look like they're just looking for a face-saving way to get out from that situation. They are just completely outmatched. One of the things we share in the newsletter is that the set of conditions right now are incentivized for Israel to keep the pressure on because the stars are aligned. You have an American president who said that Iran shouldn't have a nuclear weapon, number one. Number two, they've taken this initiative and they're winning. Winning usually begets more winning, or if something went wrong or this and that. And yes, there are casualties and civilians, and obviously it's unfortunate. War is not a pleasant thing. Trump likes to win. They've set back the nuclear program sometime, except these fortified areas that only bunker busting bombs can really get to. And now Iran is contemplating, it's been reported, stopping enrichment. They also denied that, by the way, that came out. So it's some mixed messaging. It's probably both. They're just trying to stop the pain at this point, the leadership. It's hard to see why they would let up. And Netanyahu, he's got controversy around him. He missed October 7th. He's a polarizing figure, even within Israel. Okay. And he needs a legacy. He needs wins on the board. And this is a way of establishing that. Okay. So I don't think it lets up in the near term, but I do think Trump won't stand for higher oil prices and higher gas prices. So what I expect is a tremendous amount of kinetic energy in a 1 to 2 week period. That's what I would expect. There's this expression that Machiavelli had is like, when you have good news, spread it out over time. When you have bad news, concentrate it all at once. That I expect is what happens here. And I think that is what, in fact, is playing out here. What else? This is a more significant escalation than what we saw last year in April, by the way. April of last year, had a conflict between April 3rd to April 19th. You had a soft pullback, and mini correction ended on April 19th, which coincided with the cessation of hostilities between Iran and Israel. That was the bottom. You're supposed to buy. This is broader in scope and impact. This is much broader in scope and impact. This is an escalation. Iran perceives it as war. Israel's not looking for regime change, but they are taking out leaders and hardliners, except for the Ayatollah. They don't want to create a martyr. But yeah, I think the incentives on the ground are for Israel to maintain pressure as long as the United States doesn't say stop. Iran's threat is to block the Strait, and China and Russia are saying, hell no, don't do that. That would interrupt trade for China. So Iran is just in a bad position. They're highly isolated. And Israel has really hurt Hezbollah and Hamas, which are backed by Iran. So now it's direct engagement with Iran. Iran's in a really bad position here. There's no counterpunch, no serious counterpunch. And if you're in Israel's position, you can't let the threat of a nuclear tipped warhead land on your population. So they're going to press. So I expect more of that, but I don't expect much negative fallout. Remember, what caused the stock price to go up is earnings growth and disinflation and good policy. We did not see a bad inflation report last week, and tariffs are here. That's also good news. So most geopolitical risk is fadeable. This is a good chart. And this chart shows different kinds of events that have happened. I've got a better chart. I'm going to show that chart in a second. This chart shows only geopolitical risk. I'll pull that up. So the main headline here is don't panic. Check it out. How do stocks perform after major events? So these are major geopolitical and historical events, includes everything from Pearl Harbor to 9/11 to the October 7th events. We talked about this in October 7. I mentioned you should look at this as a buying opportunity. And then a year later, the EIS ETF hit all-time highs. Defense stocks started performing very well there too. But I see this in the I don't really see much broader escalation beyond this. Saudi Arabia is not supportive of Iran. Neither is Abu Dhabi, neither is Jordan. Iran is very isolated here, and it's okay, great. So let's see, where shall we go next? Where to focus in markets? So I think the data center theme is still alive and well. I think one of the takeaways from Oracle's earnings last week is that the data center themes is strong and alive and well. I continue to like CoreWeave is one expression of that, and Taiwan Semiconductor. I highlighted Taiwan Semiconductor about 3 or 4 weeks ago. We talked about it on the show. at a 15.34 PE ratio. That was a bargain. That was a cheaper valuation than summer of 2023 before the semiconductor craze got started. It's re-rated higher, but I think there's still room to go. 17.3 times forward PE now. So it's re-rating. This business reported recently, it's a Taiwan-based company, so they report monthly per Taiwanese securities laws. They're doing 30% plus year revenue growth. Part of that's tariff acceleration, by the way, not just part of it, a large part of it. If you're a hyperscaler, you don't want to pay 10% tariff on semiconductors. So there's a lot of pull forward of demand there. But the underlying, I would say, trend rate of revenue growth is 20%. Again, you had Jensen talking about $1 trillion in CapEx spend in 2030, and he's hit his numbers and exceeded them. His forecasts have been accurate. They're evidenced. So, and nothing, I assume the hyperscalers are changing any of that. I still like the data center theme. I like financials. Financials are leading today in the market, and there's a lot of opportunities I see. It's not just like one name. I have more opportunities that I see than I have risk budget to allocate because I'm fully allocated. I see opportunities we're passing on. I think I need to create a list of here are the 8 things we see today, or 15 things sometimes, because there's a lot out there. It's not just financials. When I see that, that's encouraging for the sector more generally. I see that in consumer discretionary. Norwegian Cruise Lines is a name I've been talking about. It's up 4% today. If you want a good entry, this morning was a little bit better, but this is not bad. I think consumer discretionary is fine. I think the consumer is healthy. Over the summer, you often see a pickup in initial claims and continuing claims. Usually those are head fakes that get reversed out. I think it's some kind of seasonal pattern, which we talked about last week. But consumers are spending, the baby boomers are spending. It's hard to find a sector that I'm not constructive on. Communications are fine. Technology has re-rated. There's room to go. You got to pick securities in that market now because most of them have come up. But financials still have plenty to do. Financials, many of them are prices lower than the elections. And the elections brought in deregulation and capital relief for banks. And consumer credit is still holding up fine. And I'm seeing housing data that's also fine. And stock prices are going higher. That creates a wealth effect and greater consumer confidence. Consumer confidence is healing. And people still have PTSD of different kinds. Just in my interactions, people are waiting for the shoe to drop. That's also bullish. People are offside still. The positioning is improved, but overall people are still offsides waiting for something to drop. I think the geopolitical risk gave people a reason to sell something again. At the end of this week, the blackout period starts, meaning companies increasingly will not be able to buy back their own shares. So that'll last for about a month. And then you'll get into earnings season next month. I think getting into banks now is a good idea because they'll be the first report next month. And again, I'm seeing just a lot of opportunities across the banks, especially like the regional banks, smaller banks, and also lenders around mortgage refinance too. The large banks too, their opportunities. That's one. Healthcare is pulling back this week. I like healthcare. Defenses in general pulling back, and cyclicals and more offensive areas of the economy are advancing the ball. I think healthcare is great too. I see bargains there still being created today. They'll perform well when there is some softness in the animal spirits, when there's some softness around growth expectations. So having both in the portfolio, I believe, makes a lot of sense. What else? Digital assets. Stablecoins is a topic that is worth spending some time on. I really do think these are quite transformative. Walmart and Amazon announced that they're going to explore a stablecoin partnership. Visa, MasterCard sold 7% off on that news. That was an overreaction. In the card issuers, the ones that provide the credit cards, they have more to lose actually because they generate 1.5 to 2.5% every time you swipe a card. Visa, MasterCard, they don't make that much every time you swipe a card. They make money on it, but not nearly that much. Yeah, but the promise of stablecoins is very real. I think there's a lot of opportunity around digital banking that'll come unlocked, programmable money, where you can have autonomous agents settling, transacting with one another, and providing performing services to one another. That's going to open up another lane of productivity growth and reduce the rent seeking that you have due to the fact that you've got these established banks that have a moat due to the fact that a non-bank technology company can't compete with the bank. Whole Foods should have a bank branch. Why? They have branches. They just don't have banks. They're not permitted to. Google should be in the payments business with competing with Visa and MasterCard, right? Tesla should be able to provide financing on their automobiles using cheap bank funding and build a digital bank, right? They can't do that. But stable coins can start to open up these new lines of competition to enable technology companies to provide more bank-like services to their customers. This is a 3 to 4, 5-year story that'll play out over time. But I think the transformational impact of stablecoins is significant. Stripe is the exemplar for FinTech 3.0. They've done 2 acquisitions in the stablecoin space. They see the future. I'm not a big fan of long-term investments in, say, Circle right now. I think these are expensive. The multiples will come down, those names, but I'm excited about the innovation that's going to happen there. So those were some highlights I wanted to share with you. On search, we're starting to see search take more of a share shift loss to AI. This is the CEO of one of the AI platforms, Perplexity. And look, it's in his interest to talk down Google and hurt their share price, but you can start to see how consumer behaviors are changing around travel and tourism and e-com and lifestyle, food and drink, finance, news and media. People are shifting to answers, shifting away from search. I think Google's still fine. They got a long way to go. They've got WOYM, they got YouTube, they got strong earnings growth, good valuation. Seems to me a lot of that risk is priced in. Not worried about that risk. Plus, they've got agentic AI, which by our dev team's estimation is better than what Microsoft is fielding to. You've seen their delivery with Google VEO3, their video avatar. So I think there's still good opportunities there in terms of Mag 7 type ideas. What else? So some other thoughts on the market here. I'm going to share this part here. This is a key point. Where earnings estimates go, usually stock prices follow. And as I mentioned a few months ago, analysts lowered their earnings estimates considerably. They're going to have to walk them back up now because the earnings that are coming in are fine. They're strong, like 11, 12% year-over-year earnings growth. That's strong. And again, we're not seeing pressure from tariffs at this point in time. It doesn't mean that there aren't winners and losers. There will be. But even the losers have a lot of damage that's priced in. Let me show you Bath & Body Works, right? Retailers are in a really bad spot as it relates to tariffs. Here's Bath & Body Works, up 2% today. Actually, I bought some at the open this morning. This is not the greatest business in the world, just to be clear, okay? You can buy these products on Amazon.com. I don't know if I've got much brand loyalty to the herbal fragrances that are sold into Bath & Body Works, but let's take a look at the free cash flow yield. Gaining a free cash flow yield of 14.29%, which is levels you haven't seen since 2022 and 2020. These are high. So the point is, a lot of bad news has been priced in. This is just one example. I'm not cherry picking. We can take a look at Abercrombie & Fitch. I also picked some of this guy up last week. I have a lot more conviction in this one, actually longer term, because they've got strong EPS growth. But retailers have been destroyed due to the tariff talk. What's not priced in is my question. What's not priced in? They can rally now. In fact, I would expect breadth expansion. I would see a rotation from NASDAQ names and animal spirit names into financials and categories and leaders in those categories in retailers. I would expect something like that to play out. Let's see. Let me see what other data I can share with you here. I'm going to hop through a couple of news items that got on my radar from earnings last week. Share my screen again. Okay, here we go. This is Oracle CEO Larry Ellison notes, quote, "The demand is astronomical as the company raises its FY26 CapEx guidance." All right. This isn't just true for Oracle. It's true for the entire data center category. I can't find an earnings transcript for a data center theme linked story that doesn't have strong demand, strong backlog. The world wants data centers. I think the way to play it is picks and shovels and select plays on the app layer. I think that makes a lot of sense too. Amazon is going to invest $20 billion in the 5 years through 2029 to build data centers in Australia. I'd rather own the companies they're spending money on, bet on the CapEx receivers rather than the CapEx payers. High CapEx is actually a drag on stock prices, by the way. It's an expense. It means less earnings, but follow the money, see where they're investing. Taiwan's imposed export controls on Huawei and SMIC, but shouldn't be terribly impactful. This analyst expects outperformance in TSMC. We like that. China retail sales growth unexpectedly accelerated. I think China's still in a bull market, They've got a lot of fiscal spending, a lot of monetary spending they're putting to work here, monetary policy. Okay, if you have a detente with the United States and the tariff headlines are increasingly in the rearview mirror, I think there are opportunities there. International value, small caps, is the best performing factor combination in the markets today. International plus small cap. That in Brazil, that in Mexico, that in China. So I think there are opportunities around this. Let's see what other headlines to share with you here. Hedge funds last week buying healthcare, financials, and energy. Yeah, I think those categories are interesting. Oil's up today. Energy stocks are down. I'd wait a little bit, but energy stocks also have a lot of free cash flow yield. America is the world's leading exporter of energy. Regulations improving. It's hard to find a sector that doesn't have a constructive story. What about materials? Materials benefit from rising commodity prices. I'm not a huge fan of materials, by the way. I'm just trying to tell you it's hard to find sectors where there isn't an interesting story. Equities bought net bought for the 6th straight week. You're seeing rotation. Here's some statistics showing what happens when you have a 20% rally in 2 months. You can see 6 months out, 1 year out, based on these studies, that the probability of the market being higher, double digits, is significant. See, what's happened is this, like during these major corrections, a lot of capital gets scared out of the water and only takes the marginal buyer and the marginal seller to restore value. That's why you have these big gap ups. And those gap ups that happen leave people offsides scrambling, and they have to get back into position because they're benchmarked. And so they have to be a forced buyer. And that is accentuated when markets are moving higher because the market's running away. And that is how corrections can propel indices to new highs. It's that behavioral dynamic. That's what's at play right now. That's why one of the reasons why I'm constructive, in addition to just the fundamentals. Let's see some other highlights to share with you all here. We talked about initial jobless claims. Here's some charts of initial jobless claims. They are increasing. This is the fly to the ointment. This is the bear case. Bear case is recession. I don't see it. There's an argument that Neil Dutta from Renaissance Macro is making. He's a credible guy. He's not a perma bear. He's citing the growth in layoffs at the government, state, and local level. I don't think employers are going to lay off their workers. They have earnings growth. They want to retain and hoard workers. And I think the AI story, to the extent that creates layoffs, actually drives productivity growth, drives earnings growth. The layoffs happen in software, and those engineers will go start businesses with AI, which is actually bullish. So I don't see the weakness. Let's see. Let me know if you have any questions. I got to wrap it up here. The dollar continues to weaken. Here's a chart of the US dollar. It's plumbing new lows in the last few years. This is why international small caps are doing really well, right? If you're in an emerging market and you borrow in US dollars and the dollar drops, then the value of your liability diminishes. You got to pay back your debt in lower real terms. So a dropping dollar is bullish for international markets. Dollar is way oversold by the way now. So this is going to rally here. This will rally here. I think we have pretty good analytics around this stuff that we've been building out to show you some time. So I don't think you have to chase that now. In fact, I think US markets are pretty attractive still. I mentioned some of the categories like financials and consumer discretionary, maybe healthcare in a day or two, maybe energy in a few days, let's say, and tech in certain areas. That's re-rated more quickly. You got to pick your spots there. But anyway, I think there's just a constructive backdrop overall. This is a chart worth taking a close look at. This is a chart I trot out every quarter. This is the growth to value ratio in the S&P 500. Now, when this gets to a peak, usually bad things happen to growth stocks. So we want to orient towards value. That's why I like financials and discretionary and select technology, right? We are now at levels that you've seen at 2021 tops and February 19 correction. The difference between now and then is that the trailing PEs can still run up higher. The forward PEs are too low because analysts are overly pessimistic due to the tariffs. So this is a kind of the case of objects in mirror may appear closer than they actually are. But you should be repositioning your portfolios though. Things that have worked the best since the rally should start to lag and give up to other names. So rotations are in order. Okay. That's all I got. Hope you had a lot of fun. Maybe we can connect again later this week, can share a lot more data. And if you enjoyed that reading of J.D. Rockefeller's letters to his son about heaven and hell, how cool was that? Let me know, and I'm happy to do that again. I enjoyed it. All right? Take care, folks. Make it a great week. Be well.
Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Alawalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.